Okay, let's dive into this. You know, in the world of finance, we lean on these rules, these big assumptions that feel as solid as the ground beneath our feet. But what happens when one of those core rules just snaps? That's exactly what we're going to get into today.
See, the whole financial system kind of runs on these cause and effect beliefs. For decades, one of the most reliable was this. When a big conflict kicks off and threatens the world's oil supply, a very specific chain reaction is supposed to happen. Well, just recently, that chain completely broke.
And this slide right here, this really gets to the heart of the problem. You've got one single event, an oil price spike, that's pulling the market in two totally opposite directions. On one side, you have this inflation fear. Prices for everything go up, and the expectation is that central banks have to step in and raise interest rates to cool things down. But on the other side, you get a growth scare. Why? Because high oil prices are like a giant tax on all of us, slowing down spending, hurting the economy, which would usually mean they should cut rates. For years, the market always worried about one of these more than the other, but that has all been turned on its head.
To really get why this change is such a big deal, we gotta rewind and look at the old playbook. Let's talk about how things were supposed to work.
So here's the classic thinking, step by step. An oil spike means it costs more to make and ship everything, right? That fuels inflation. To fight that inflation, central banks are pretty much forced to raise interest rates. So investors, seeing this coming, demand a higher payday on government bonds, which sends their yields way up. Simple. Predictable. And for a very, very long time, it was totally reliable.
But then, a massive global event came along and put this old rule to the ultimate test. And believe me, the market's reaction was not what anybody saw coming.
And this wasn't just some theory, right? We're talking about the conflict in Iran, where geopolitical tensions were threatening some of the most important oil supply routes in the world. This was the exact scenario that old rulebook was written for, a sudden, scary, and sharp spike in the price of oil. And this wasn't just a little jump either. The main U.S. oil price shot past that critical $100 mark. I mean, that is a massive, flashing red light for inflation, a huge warning sign for the global economy. The stage was perfectly set for that old rule to kick right in.
So after everything we just laid out, the next logical step, the only logical step, will be for bond yields to shoot sky high in response, right? The market followed the rules, didn't it?
Nope, not even close. In this absolutely stunning reversal, both bond yields and what people expected the Fed to do with interest rates, they both went down. At the exact moment inflation risk was screaming from the rooftops, the market did the total opposite of what the old playbook said it would. It's like you slam your foot on the accelerator and the car just slows down. What on earth was happening?
And this, my friends, brings us to the very heart of the mystery. The market was faced with a choice between two big fears, inflation or a slowing economy. And all of a sudden, it picked a brand new favorite to worry about. And here's why. The market began to see this oil spike less as an inflation problem and more like a massive surprise tax hike on absolutely everyone. Think about it. When you and I and every business out there are forced to spend way more on gas and energy, we have less money for everything else. That spending is the engine of the economy, and the market suddenly realized that this new tax was a much bigger threat to growth than inflation was.
This quote from a macro strategist just sums it up perfectly. The bond market, that's fixed income, it wasn't that they were ignoring the inflation from the war, which somebody cleverly dubbed warflation. It was just that the fear of a total economic slowdown, that growth scare, it just became the bigger, badder monster in the room.
So what does it actually mean to live in a world where this old, reliable rule is just broken? Well, it fundamentally changes how markets work, and it pushes us into a much, much less predictable world. This brings us into a new type of environment, what the pros call a random walk market. Now, normally you can look at past trends or what investors are feeling, their sentiment, to get a sense of where things are going. In a random walk, yeah, you can just toss all that out the window. The market isn't being driven by predictable feelings of optimism or pessimism anymore. It's being driven by the chaotic, minute-by-minute drip of breaking news. As Harry Colvin from Longview Economics puts it, it's not really about how much risk investors are willing to take on anymore. It's simply about what the next headline is going to say. Is there a new development overseas? A single comment from a world leader? That's what's moving billions of dollars now, making the entire system dependent on things you just can't predict. Okay, so let's bring this all home. What does this new reality actually mean for how we should think about the financial world? So here is the bottom line. That old, reliable connection between an oil spike and higher bond yields, it's gone.
The fear of an economic slowdown is now officially a bigger deal than the fear of inflation. This has shoved the market into a random walk, where breaking news is king, not investor sentiment. What that leaves us with is a market that's way more volatile, way more unpredictable, and where all the old models, well, they just don't work anymore.
And that leaves us with a really fascinating and maybe a little unsettling final thought. When all the old maps are useless and the market is just being jerked around by the chaos of the daily news cycle, does planning for the future even work anymore? Is just being reactive the only real strategy we have left? It's a question that everyone from the top traders on Wall Street to the rest of us is now trying to figure out.